Holy smokers, this ain't no dang jokers, folks. Do we have a lot to get into this video? The market's going absolutely nuts. We got to talk about that, the state of the market. We got to talk about Meta. Meta earnings just came out. We got to talk about Best Buy. Horrible news just came out of Best Buy. We got to talk about PayPal. PayPal stock went through the roof today. Shopify stock went through the roof today. We got so much to get into in today's video, guys. Hope you enjoy this. As always, I told you this week was going to be complete madness, and it is, okay? Yes, the NASDAQ made an over 4% move here today. Yes, over 4%. That rarely ever happens that the NASDAQ goes up over 4%. Just absolutely insane. Look at the moves. I pulled up just the stocks that I have money in personally. I had 16 stocks that made a 3% or more move here today. Absolutely insane, including PayPal, which we're going to talk about later in this video, up over 12%. Shopify up almost 12%. We're going to talk about that one later in today's video. We talked about Google in yesterday's video. That one's up 7.7%. Palantir 6.6%. Meta 6.5%. The moves are epic, okay? Epic nonetheless out there. Absolutely insane. This was the definition of let's go risk on. That's as simple as it goes, okay? Risk on across the board here today. You pull up a heat map and it is just, it's right in front of your face, man. It's green everywhere other than maybe healthcare and Visa. Just about everywhere else, look at it. I mean, it's just a sea of green. If you didn't make money today, I don't know what to tell you, okay? Maybe you're a short seller or something like that, because today should have been a very positive day in your accounts here today, okay? So the Fed came out. They announced they're going to raise, by 75 basis points. So we're in the situation now that the Fed looks like the worst is likely behind us in terms of the Fed raising rates, right? The Fed basically told us and telegraphed us that they're starting to see some weakness in the economy, but they still see a lot of job openings. So that kind of gives, I would call it the Fed's kind of walking a tightrope right now, where they don't want to seem a little too hawkish. They want to seem a little too dovish. And I think that's kind of where the market wants it right now. I feel like the market wants the Fed to take it kind of month by month right now and quarter by quarter and look at everything that's going on, because what we know is inflation's sky high right now. But the belief is inflation's going to start coming down, right? So you don't want the Fed to go too crazy with raising interest rates, because, they might go too far to the other side now. Remember, the Fed lagged on the other side, right? They lagged when it came to raising interest rates. And that's part of the reason we got into this mess. It's not the only reason, but it's definitely part of the reason we got into this mess of super high inflation. Now, if they go too far to the other side, right, we could end up in a situation where they completely kill the economy. And you get inflation down, but then all of a sudden you're in a completely devastated economy. And we know based upon a lot of what we look at, okay, and this is very important, we know the economy is weakening. We know this, okay? You see it in these companies' numbers. You see it in the real estate market. We know we're starting to see the cracks in the economy happen. And part of that Wall Street likes, part of that Wall Street wants to see, because they want to see inflation come down, and they want to see the worst behind us when it comes to Fed raising interest rates. So part of that is something that Wall Street ultimately wants to see. They want to see a slowdown actually in the economy, and that's very rare, because usually, if anything, on Wall Street, you like to see the economy heating up, right? Getting better and better. Not right now. Everybody kind of wants to see slowing, but at the same time, they want to see the Fed go too crazy, right? I mean, if the Fed could have raised by 300 basis points today, everybody would have been freaking out, and the market would have been down 4, 5, 6% here today, right? Keep this in mind. We are still significantly off of all-time highs, even after a massive move today. Russell's still off about 25%. The NASDAQ's still off about 25%. So keep in mind, we're still a long way from any of those all-time highs we reached. And keep in mind also, you saw a move today like the NASDAQ up 4% plus. Meanwhile, the S&P and the Dow were only up 1 and 2%. Well, remember, the NASDAQ has a lot of catching up to do, and if we were to go into a risk-on period over the next few months, the NASDAQ has a lot of catching up to do. Usually the NASDAQ should be within 3 to 5% of the S&P 500 and the Dow. Right now there's about a 9% spread there, right? And about 12 percentage points between the NASDAQ and the Dow right now. That's an abnormal number. Let's just call it that, okay? Best Buy came out here after hours and announced just out of nowhere, bad news, okay? Very bad news. Best Buy on Wednesday cut its forecast for the year in the second quarter, saying it's seen weaker demand for consumer electronics amid inflation. These two paragraphs are the key ones. The consumer electronics retailer said now it expects same-store sales to decline about 13% for the second quarter. Guys, 13% same-store sales, awful. I mean, just about as bad as you'll ever see it. Let's just put it that way. I don't even know in the great financial crisis if Best Buy got to 13% same-store sales. They probably did, but that's an obliteration, okay? Oh my gosh. That's lower than it said in May when it predicted roughly in line with the first quarter when it dropped 8%. So they were expecting 8% same-store sales decline, which is already just awful. You should never see an 8% decline in your same-store sales. But if you see 13%, that's like end of the world type numbers, just awful, okay? Quote, as high inflation has continued and consumer sentiment has deteriorated, customer demand within the consumer electronics industry has softened even further, leading to Q2 financial results below the expectation we shared in May, they said, okay? So, bad news. No, I saw this and I was like, oh my gosh, man, first off, we should have probably seen this coming because Corsair pre-reported bad, horrible numbers. Logitech reported bad numbers. So if Logitech and Corsair have bad numbers, likely that's going to boil over into a company like Best Buy, right? And so I was thinking, oh man, that probably was such an attractive, short, easy candidate there. And I'm like, that stock's probably down. I would guess 8 to 15% after hours. 8% maybe best case scenario, 15% maybe worst case scenario because of how bad the same store sales came in at. So far worse than expected. Meanwhile, the stock's down 3%. 3%. That's it. And here's the deal, man. When you start getting into a market that is, talk about this stock, right? 52-week range, it was $141, $142 stock at one point. It's half that today. So it's already priced in a lot of bad news. And so you get devastating news like today and 3% down after hours, that's like nothing. When you talk about your same store sales are going to be down 13%, oh my gosh, okay? But that's a market we're in, right? Where folks you're just starting to run out of sellers in these stocks. You're starting to run out of sellers. People are like, yeah, same store sales are crap right now, but we already priced this baby. We already cut it in half. So we already priced for this devastation. And likely some people are viewing it as we're in the worst quarter or the next quarter will be the worst quarter and then we'll start getting a little better and a little better. And people are also looking at it from year-over-year comps will be in a better position, right? That leads us to Meta. Oh boy, okay. Good old Meta. What happened here and what's my opinion? This is a stock I personally own, okay? Earnings came in at $2.46 a share versus $2.59 was expected. That's obviously a miss. Revenue came in at $28.8 billion, $28.9 billion was expected. Very slight miss there. That's basically in line. Daily active users slightly beat, but that's basically in line. Monthly active users slightly missed, but that's basically in line. And ARPU, average revenue per user, basically was in line, okay? So, not a disaster. Not a disaster as far as that goes. The disaster, though, was here in the guidance. The company said sales in the quarter, the upcoming quarter, will be in the range of $26 billion to $28.5 billion. That analysts on average had them at $30.5 billion, okay? So basically the midpoint, you want to run the midpoint between $26 billion and $28.5 billion, right? The midpoint is over $3 billion below what analysts had. So if you were to say, okay, a company is going to report earnings and their midpoint's going to be $3 billion plus below what analysts were expecting, you would automatically assume that this stock has to be getting just absolutely torn to shreds after hours, right? Especially given that this stock was up huge today. It was a massive upward day, right? Well, it's not. I've seen the stock anywhere from about down 1% to down about 4% after hours. 1 to 4% move? Oh my gosh, we'll take that any day of the week. When you just miss your guidance by over $3 billion in the midpoint and your stock's only down 1 to 4% after hours, you will take that any day of the week. But here's the situation with Meta, okay? And here's why this is very, very important. By the way, I have, this is the account I have the most Meta shares in right now. I have 533 shares in that particular account. I thought I would be loading up on shares because I thought the stock might be down 10% plus after that huge, guidance miss there. But Meta is one of those stocks that I'm adding across all my accounts right now, and I plan to continue to. The death of Meta has been greatly exaggerated. Let's just put it that way, okay? And here's the deal with Meta, and here's why a lot of investors like myself are buying this stock right now, despite a bad guidance like that. The reason we are is, first off, we understand how sticky the product is. At the end of the day, if people want to make fun of Facebook or Instagram or whatever, the fact is People use those products like it's nobody's business and have for years, and they continue to. You look at the monthly metrics, you look at the daily metrics, they're off the charts, okay? Phenomenal. People still use this product heavily. They also own WhatsApp as well, right? The company trades at a 12 to 14 trailing P and forward P. It's insanely cheap stock, right? It trades at a price to sales ratio under 4. This stock historically has always traded at a price to sales ratio of over 10. And historically has traded in the PE ranges of high 20s to even I've seen it trade, in the 40s in the past. So when you're talking about it's trading this cheap, it's basically like you're getting money for free, right? Now imagine a situation if they were to cut expenses. This company added a ridiculous amount of employees over the past few years, and they're spending like insane for the metaverse. Imagine if they were to dial the expenses back a bit. Then imagine how profitable this business model is. It's already insanely cheap with them doing all this spending for the metaverse and everything, right? And all the employees they've added, the crazy amount of money that they're pumping into R&D, and they're still this profitable. Imagine if they cut that back a bit. Then imagine how profitable. And so that's why a lot of us are looking at this and are like, dude, with this balance sheet the way it is, with how profitable this company is, with how sticky the products are that this company has, it's basically like getting free money right now. And so that's why we continue to buy shares and we continue to load up on this stock. And like I said, this isn't one of those stocks that I'm the only one buying. There's a lot of big investors adding shares of this company right now. And that's one of the reasons why it's hard to get the stock to go down much more. It's already priced in so much bad news. I mean, that stock, is another one of those. You look at the year to date for Meta, it's down probably close to 50%. It's another one of those stocks that's been cut in half. And straight on a valuation basis. That's what it's been cut in half based upon a valuation basis. And now it's trading that cheap with that balance sheet, with those products this company has, and the opportunity in the future. Come on, man. Give me free money, and that's Meta. Shopify. So this stock made a massive move up here today. 11% plus upward move for Shopify here today. After yesterday, it was down 14%. So talk about a volatility, a stock that's just insanely volatile, right? That's Shopify. So Shopify, you would have thought, they had to report amazing earnings being up 11% plus, right? Well, earnings came in at a loss of 3 cents a share, adjusted, versus an expected gain of 2 cents. That's not good at all. Revenue came in at 1.3 billion. 1.33 billion was expected. Okay, so slight miss there. Yeah, earnings were not some amazing thing. The guidance was, there's nothing to be excited about as far as guidance went. So, and then the stock goes up 11% plus here today, right? Well, remember, Shopify is a stock that year to date is down 74%, okay? And so when you start talking about these sorts of companies that are down year to date 50%, 60%, 70% plus, right? They have already been priced for devastation. So if Shopify doesn't come in with devastation and they only slightly miss on revenue, boom, 11% up, right? And a stock like Shopify will continue to move up over the next year or two, as long as they don't report devastation. As long as they don't come in like the whole business is wrecked, they'll just continue to move up and move up and move up. They don't even have to. They don't even have to announce anything exciting. They don't have to announce any game-changing numbers, any game-changing products for the next year or two, and that stock will move up and move up and move up and move up because it's already been priced for devastation. That's how it is. When your stock's down 70% plus, you've been priced for the end of the world. And if the end of the world doesn't come, you make some absolutely epic moves to upside, and then other people are looking at it and they're like, what's so exciting about Shopify? None of their numbers are exciting right now. Like, what's going on here? Yeah, the stock's already been priced for the end of the world. So just don't have the end of the world come and you'll do just fine. PayPal. Speaking about stocks that have been priced for the end of the world, PayPal makes up move over 12% here today. What happened with PayPal? Well, Elliott, an activist called Elliott, and they've been involved in several different stocks in the past. Basically, it's come out that they've made a move on PayPal, essentially, invest in this company. Now, when it comes to this Elliott, there could be a few things at play here. They might want PayPal to maybe aggressively buy back shares. They might want to try to get PayPal to, essentially, the idea here is you buy a bunch of shares of a stock. Then you start getting some influence and you can start trying to talk to the executives of the company, the board of directors, and try to convince them to do certain things, right? And if you own a significant amount of shares, the board of directors and executives might be a little more likely to listen to your propositions and your opinions, right? So they could want PayPal to cut way down on R&D and expenses. There's talk that they could get margins from 25% to 40% if they cut expenses in a major way. And there's a belief, at least from some folks, that that would not necessarily hurt the business model very bad at all. And so if that's a situation, you could be talking about a PayPal that emerges as a way more of a profitable beast than we've ever seen in the past when it comes to PayPal. So that is at least part of the belief that could happen there. And people get excited about this, right? Because they look at PayPal and they're like, they own PayPal and Venmo, two of the biggest financial related services in the world. Those platforms just continue to grow. We know it's a growing company, right? Even if the economy's bad, and let's say the economy's bad in 2023 for whatever reason, right? PayPal will still likely be a growth engine, and that's one of the few companies that can grow even in a recession. Never mind if the economy is very good, PayPal will grow quite immensely, right? And so people look at this and they're like, this is a pretty dang good opportunity here. And on top of that, PayPal's been priced for devastation. Even after today's huge move up of 12% plus, that stock is still down 55% year to date. 55%. It has been priced for the end of the world, right? And if the end of the world doesn't come, PayPal makes a huge move up. Also, keep this in mind. This is very important. Visa numbers came out. They were great. American Express numbers came out. They were great. And I mean great. Visa and American Express, those were A, if not A plus type quarters. Absolutely amazing. So if Visa and American Express are reporting very strong numbers, there's a good probability PayPal is going to report some actually pretty strong numbers as well. Maybe not as strong as Visa and American Express, but pretty respectable, right? And once again, the stock has been priced for end of the world because it's down 55+%. And it's not a high valuation name when it comes to PayPal either. That's the thing. When it comes to PayPal, that's a stock that trades at a PE of under 30, even with their crazy amount of spend that this company does, that you could say they could easily cut back on. Because they say, well, you already got PayPal, you already got Venmo. Like, do you really need to spend all this money on R&D? And I think it's a fair question, right? Are they really going to do anything that innovative that's going to so far change the game? Maybe they are. Maybe they're not, right? And maybe, this time period we're going through of all this recession concerns and everything going on with inflation, maybe it's a time period where PayPal could potentially, let's just call it lighten up on expenses and end up creating a business model that's far more profitable than any PayPal we've seen in the past. And it's already trading pretty darn cheap going into this, okay? So that's going on. It's clear as day all of a sudden the whole financial markets want to take risk. It's clear as day all of a sudden it's risk on, right? Look at Bitcoin up 8% plus. Look at Ethereum up 15% plus. But look a little deeper. You always want to look a little deeper, right? Look at the Ethereum chart. Look at the chart. As soon as the Fed came out and did their dang thing, Ethereum started shooting to the moon. And anybody that wants to try to say, Bitcoin and Ethereum don't have anything to do with the financial markets, BS, okay? These things move based upon risk. And if folks are going risk off, these things tank. And it has nothing to do with the crypto community or anything like that. Bottom line, if we go risk off, Ethereum and Bitcoin fly down, okay, in a bad way, and they crash. And if all of a sudden we want to go risk on, NASDAQ's moving up big, it's just overall enthusiasm out there to take risk, Bitcoin and Ethereum make some absolutely massive moves, and there's no debate about that anymore, okay? The only debate is, do we remain kind of risk on for a while? And the biggest, I'll tell you, it's all going to depend on these two companies tomorrow. These are the last two major companies of earnings season. We got a ton more earnings coming over this earnings season, but these are the last two major companies to report earnings, Apple and Amazon. If it's not the end of the world and they actually report decent numbers, we'll remain risk on. But if Apple comes in and says, hey, consumers getting really, really weak and our numbers are going to likely be very light for the rest of this year, then you could see, oh boy, we're back in a risk off again because people are like, oh boy, the recessions, we're getting more confirmation. And when you talk about Apple, you're talking about the biggest market cap in the world. So those earnings on Thursday after the bell are going to be extremely important. I'll definitely cover that for you guys as always. If you're looking to join my private stock group and private Discord chat and learn how to value a stock so you know if it's overvalued, undervalued, or fairly valued, if you want to learn how to understand financial statements like a CPA would, if you want to get access to my dividend investing mastery course, my Becoming Master of the Stock Market course, and my Thriving in a Recession course, which I just added a new video that's absolutely amazing. It goes into detail on exactly how business models can emerge coming out of a recession to be far more profitable than they ever were in the past, and exactly how that process goes. Added that last night to that course. It's pretty darn awesome. And if you want to get access to my private Discord chat and know what moves I'm making in the market, check out the pinned comment down there and apply to join us in the private stock group. Much love as always, and have a great day.